Hello students and welcome to Legacy IAS Academy. In this session, we will be looking at the benchmarking infrastructure development report. So let's see what it is all about, who has brought in and what it talks about. So recently the World Bank has released the benchmarking infrastructure development report. Okay, and we'll see what it means, what it has analyzed, and what are the challenges and solutions in that, specifically with respect to India. So let's get started. About the report has, so for benchmarking infrastructure development, this report has analyzed the PPP projects, the PPP regulatory landscape. What is PPP? PPP is public private partnership. It is public private partnership across 140 economies, right? And suggests a significant correlation. It has suggested a correlation between what? Regulatory reforms relating to PPPs and PPP infrastructure investments. It has shown the linkage or the correlation between the presence or absence rather of the regulatory reforms and the PPP infrastructure investments. So the better the regulation for PPP projects, the better would be the investment, is what the report is going to mention. Okay, so what is PPP, public private partnership? See, as far as let's say this is concerned, projects are concerned, infrastructure projects are hugely costly. They cost a lot. There is a huge gestation period. That means the returns are going to come after years and years of, first you have to invest for years and years, and only then let's say revenue is going to be generated. So that means high gestation period is there. The cost is high. So the government needs a lot of money to build infrastructure projects. In fact, a few years back, India had said in the coming 10 years, India would need $1 trillion for the infrastructure development. Now, that much amount the government does not have. Earlier, what used to happen? The government has the money, they create the project, end of story. Now, since government wants more development, we need more money, then we need to take private companies into account. We have to involve their investments as well. Then that's when this public-private partnership is talked about, wherein almost all or majority of the investment is of the private company, right? So if I have to take an example of, let's say, Hyderabad Metro Rail project, right, around 90% was the investment of L&T. It was around a 17,000 crore project, and only 10% was of the government. Then what does the government provide? The government will provide the land for the development, right? So the government would give the land. At the same time, how is L&T going to earn the revenue? After constructing the project, L&T is going to basically run it for around 35 years, and whatever revenue is generated goes directly to L&T in order to recover the cost that they have incurred. So this is the concept of public-private partnership, wherein the private investment is also attracted. I hope that is absolutely clear. Now remember, that is why what happens, you will see lot many tolls are coming up in every expressway, left, right, center. See, you have already paid the taxes with the help of which the road should be constructed and you should go free. But you see every other road will have toll tax. Why? Because a private company has constructed that with their own money. Some of the money can be ours, which is taxpayers, but it can be all or majority of the money is theirs, and now they have to recollect that money, generate the revenue which is through the tolls. So not just that the government collects taxes, then ask the private company to use their own money, and then again they are collecting toll tax from us. So it is actually double taxation here also. I hope this is absolutely clear. But anyhow, this was the concept of public-private partnership. Now, what is the key highlight of the report? First, it talks about the public fiscal management system, which is, remember 140 economies have been analyzed. Now, only 19 economies have adopted specific provision for public fiscal management system. So you can see the PPP is, not properly managed with respect to the fiscal responsibility. Further, if robust management system would be there, it will mitigate potential financial sustainability issues. But what is the scenario? Only 19 economies have adopted specific provision for budgeting, reporting, accounting, etc. Fiscal management is what? It is this only. And only 18 economies publicly disclose the liabilities. Only 19 economies have this, only 18 economies publicly dispose the, let's say, populate the data. Okay, I hope this is clear. Now, furthermore, if you look at monitoring and evaluation, only 37% of the economies require payments linked to the performance. The others have not even linked it. Again, can be a reason for a huge downfall. Then renegotiation of the PPP contracts. At times there would be a need for renegotiation, but is it present? No. Only in 19% of the economies it may be there. What is renegotiation? See, what happens is, I told you 17,000 crore was required. Now you estimate how much revenue you can generate over a period of 35 years for which the contract is there. Now it can so happen after 25 years, 30 years, you realize that the revenue is not completely recovered. In fact, not even half is recovered. So the contract needs to be renegotiated. Because you see, you cannot say no, you decided, we decided, this is how it will be. No, renegotiation is required, or else the company will be in loss. Company may stop working, there will be bankruptcy, etc., etc. There can be a lot of issues. The capacity of the company can go down, so on and so forth. It can be the other way also, that we realize that 35 years were given, but just in 15 years everything is recovered. This much discrepancy may not be there, but it's possible. So whenever such discrepancy is there, the contract needs to be renegotiated in order to safeguard both the company as well as the taxpayers' money, the government, right? So even if government is losing money, it is the taxpayers' money. So it is safeguarding the company as well as the exchequer of India. Now, what are the challenges? Financial challenges. What financial challenges? There is aggressive bidding and project underpricing. See, why this aggressive bidding is there? Because in India, for the bidding process, we follow the L1 rule. What is the L1 rule? The company who bids the lowest gets the contract, right? So that is why each and every company will be fighting each other to bid the lowest. And then what happens? That company gets the bid, that bid gets the project. Later on, they realize they don't even have the capacity and they're not able to sustain under this particular costing. And when they are not able to do it, then it leads to delays, it leads to stoppage of work, which again will lead to cost overrun. Cost overrun will be there, more money would be required. At the same time, when delay is there, that also converts into cost overrun only. That means additional money being spent, results into delays, resulting into cost overruns. Capacity and procedural challenges. Inadequate management capacity of public sector. The PPP project needs to be managed. The company is doing the work, but still the government has to manage it. The capacity itself is not there to manage such projects as well. I hope this is absolutely clear, let alone environmental impact assessment and various other things which are required. What are the challenges of PPP in India? Number one, regulatory and institutional gaps, absence of comprehensive national PPP policy, regulator for PPP project, all that thing is missing, right? But what is the existing framework? A separate regulator is missing, but is there some amount of framework? Yes, there is. What is there? A private investment unit under the Department of Economic Affairs, under Ministry of Finance. So a private investment unit is there. There is a PPP vertical under Niti Aayog as well. So attached offices kind of things are there, but separate entity is not there. And for that particular thing, there was a Kelkar committee in 2015 which gave certain recommendation. The very first recommendation was establishment of independent sectoral regulators. So PPP is a sector like that. There can be other sectors. So infrastructure can be a sector XYZ. You can divide sector with respect to various criteria. So once you divide it, mention about it, recommended independent sectoral regulator. Why? To ensure harmonized performance in sector in PPP. Okay, so independent regulator has been recommended. At the same time, discourage unsolicited proposals. Unsolicited proposal means uncalled for proposals. The proposal for which the government never opened the contract, or never asked for any bids, but still private companies are coming up with their own estimated projects, potential projects to the government. So that is unsolicited, uncalled for. So it asks for discouraging such unsolicited proposals, so that there is no information in irregularity. What can happen? Big firms can estimate their own project and come to the government and get it. Others may not even know about it. So you should give away only those projects which are solicited by the government. The government solicits that, asks for it, and then anyone and everyone who fits the criteria can bid for it. And then finally, establishment of National Facilitation Committee to ensure time-bound resolution of the issues with respect to the PPP projects, including the issues with respect to getting timely clearance. Because as I said, the government will provide the land. Now for land, you need land clearance, and there can be a delay if land is not there, which will lead to cost overrun. So an independent establishment of National Facilitation Committee is also recommended by the Kelkar Committee. So this was about the World Bank's report and its connection with India with respect to PPP project. Thank you.